Hello, everybody, and welcome to Law at the Library, a partnership between the Evanston Public Library, the Chicago Public Library, and the Chicago Bar Association. My name is Lorena Neal. My pronouns are she, her, and I'm the legal literacy librarian at the Evanston Public Library. We're delighted to have you here tonight to discuss changes in tax law. Know before your file. Our presenters tonight are Genevieve Red, a legal consultant for JP Morgan Chase, and Michelle Kuipers, staff attorney and director of the legal clinic for Ladder Up. I'm here to tell you a little bit about the format for this evening, and then we'll get started. I'll introduce our speakers, who will then give the presentation, followed by a question and answer period. If you have any questions for our speakers, please type them into the Q&A window, which you will find near the bottom of your screen, or you can also use the chat feature to ask your questions there. I will collect your questions as they come up and give our presenters the opportunity to answer them at the end of the presentation. So feel free to add your questions whenever you think of them. And if you have any technical issues or questions, feel free to direct those to me in the chat as well. Our next Law at the Library topic will be Consumer Law Dealing with Debt on January 23rd. I will link the page with the schedule and the registration links into the chat in a moment here. You can also see videos of previous presentations of Law at the Library on our Evanston Public Library YouTube page, and I will post a link for that playlist in the chat as well, in case you're interested. We also have a list of general free and low-cost legal resources at the EPL website, so I'll add those links. Our first speaker tonight is Genevieve Red, a legal consultant for JP Morgan Chase, formerly of the Office of Chief Counsel for the Internal Revenue Service, or the IRS. Our other speaker for this evening will be Michelle Kuipers, staff attorney for Ladder Up, an organization that provides free financial consulting resources to help clients secure the opportunities they need to move up the economic ladder, which include a tax assistance program, legal tax clinic help, financial aid for college, and financial literacy. Welcome, and over to you, Genevieve and Michelle.
Thank you so much. And thank you for having us tonight. And a big thank you to Michelle for doing this. I am the co-chair of the Chicago Bar Association Fed Tax Committee for the Young Lawyers section. And it is our distinct pleasure and honor to present for the Law at the Library series. And Michelle is doing this simply because I asked her to. As a former prosecutor for the IRS, I can help you guys to a certain extent, but Michelle really knows what you guys need to know. So I can tell you, if you really get into hot water, I can help you out, but Michelle can help you not get into hot water, which is why I asked her to present tonight. And she also provided the most useful content on these slides. So big round of applause to start for Michelle.
Well, thank you for that glowing endorsement. And I'll just take just a second to explain that, I'm also here in my capacity with Ladder Up, and Ladder Up is a nonprofit in Chicago and all of Illinois. And we do offer free services for financial literacy, but tax preparation. And as Genevieve mentioned, the aforementioned hot water, the legal clinic does assist with anyone who has IRS or Illinois Department of Revenue controversies, if we want to use a neutral term. So please don't hesitate to reach out to me, to Ladder Up. Even if we can't help you for whatever reason, we can try and direct you to somebody who can.
Yeah, and you're absolutely welcome to reach out to me as well. I'll probably direct you to Michelle or somebody else at the Bar Association, but I'm happy to help in any way that I can. Okay, so getting started. Let me see here. This is who we are. We're very excited to be here. Here is the Law at the Library series dates for you all, and we will make these slides available so that you all have access to them. We're going to go ahead and start with an agenda tonight. Oh, disclaimer. Sorry, because we're lawyers, we have to give you a disclaimer. Disclaimer, it's necessary. The presentations for informational purposes only. The following materials based on existing U.S. federal and state tax authorities as of the date of this presentation. This document is not intended or written to be legal advice or used for the purpose of avoiding penalties that may be imposed. So you cannot say, oh, but Genevieve and Michelle told me to do this. No, we did not. This is general educational material. It is not specifically tailored to your situation. Okay, so here's what tonight is going to look like. Doing introductions, then we're going to do some tax tips for seniors, self-employed self-help, Environmental tax credits have come up a lot this year, making your home more energy efficient, as well as environmentally friendly cars we're going to talk about for a little bit. 1099-K changes, retirement fund limit changes, social media, tax hygiene, news that you can actually use, and VITA, which is the program that Michelle's clinic works through, what to do, how to figure out if you qualify, what to do if you don't qualify. A lot of people don't qualify for VITA. It's totally okay if you don't. We're going to talk to you about what to do if you don't, and we're going to take some questions. Okay, so first things first, again, these slides are going to be available to you after the fact, but I wanted to, I'll just go ahead and minimize that. I wanted to walk everybody through some very practical resources. I know that in tax law, there's always like, especially on social media, there's a lot of like, hey, do this or do that. Well, the best source for tax research is actually the IRS website. And the reason for that is it's going to have the most up-to-date information. The IRS is actually a branch or division, you could say, of the Department of the Treasury. So they're going to get the information first because the Treasury has a bunch of like very smart PhD people who do like tax and philosophical research for years and years and years and years and years. And they write these regulations. They go through the whole process. And then as soon as they publish it, I mean, it takes 20 or 30 years to publish some regulations, sometimes longer. Once they publish it, it goes out through the IRS website. So you're going to get the most up-to-date information from the IRS website. A lot of lawyers, a lot of accounting firms will give you like a news update. Lots of times those things can be a few years old and it can be misleading. So what I always recommend to everybody is that just go straight to the IRS website, right? And if you don't know what to look for, you can just Google IRS and then whatever you have a question about. So if we're looking at, tax tips for seniors, they actually have a whole guide and for a tax guide for seniors. And when the IRS has a formal guide for something, they usually call it a publication. Publication 554 is a tax guide for seniors. It's going to come as a giant PDF, right? They're going to have former versions of it. Look, right here, they've got a link to low-income taxpayer clinics. If you click on that, it's going to help you find an LITC close to you. Fun fact, that's going to be Michelle's clinic. Okay, going back to our PowerPoint. Okay, self-employed.
I do want to take a note on the 1099-K thing here, and much to your point, which is that the IRS website is going to give you the most up-to-date information about what the IRS's regulations are. The 1099-K situation was that they were requiring payment servicers to issue a special tax form that had never been issued before for less than $20,000. Now they were saying everybody who interacts with a payment servicer like Venmo is going to get one for $600 or more. So this was going to be a huge change. Last week, the IRS informed everybody that they were delaying this change and it would not apply to 2023 taxes. So you might have seen some weird TikTok that said you're gonna have to be taxed on your Venmo payments. Well, no. Luckily, that has been delayed. 2023 is not going to have that change. And then they're going to be phasing it in starting in 2024 with a $5,000 threshold. So this is something that is thankfully the IRS has listened to practitioners and made the change, probably with the Department of Treasury's involvement, but they have issued the most updated to date information so that everyone who is preparing taxes this year can look at that and go, phew, we're not going to have a bunch of people coming into our office with a $600 PayPal transaction because they sold their couch this year,
Yeah, and that's a really good point, Michelle. Just to echo that, like lots of times, it does take 20 or 30 years to put together these really complicated tax changes. And they finally publish them and then, the public will go into an uproar because it doesn't actually apply to real life the way it was intended when they drafted it 20 years ago. So just like this situation, they'll say like, oh, you actually should have a 1099-K. Like if you're getting more than $600, yeah, you should totally have to report that. That makes sense in some situations, in a lot of situations. In the 90s, getting paid more than $600 was a big deal, right? Now with Venmo, like, oh, not quite so much. So, you're going to get out of date information, even if it's only like a month old or 3 weeks old. So that's why we're providing these links, not to say like, oh, don't like, maybe if you see something on social media, that's a good place to get ideas for things, but you always want to fact check it, get it straight from the horse's mouth at the IRS. And we do provide some third-party websites like AARP or the New York Times that are a little bit more credible, the Wall Street Journal. Some of them have paywalls, but you can get a few free articles from them that are going to be super helpful. I won't walk you through all of these because they're all just the IRS ones, but these are very reliable. Again, IRS. For updated tax brackets, I'm sure Michelle's going to walk through them a little bit later, but if you want to look them up on your own, the AARP, generally I love them for like how to do adulting situations. I find them very, very helpful for like general financial know-how. They really break a lot of stuff down in layman's terms. I find them very helpful as someone who's done not just tax planning, but like estate and retirement planning. The AARP is very good for giving you very neutral things in very simple terms. The Wall Street Journal tends to be a little bit more complicated in language, but they also give you more like nuanced information, as does the New York Times. And again, best source is always going to be the IRS, just because they're the ones who are going to be like, oh, by the way, we're undoing that thing we told you about. When it comes to social media, to Michelle's point, just no. And when you have questions about things, really quickly, a lot of people say like, oh, how do I do this? Or how do I do that? Or, like, oh, my lawyer said he can file my taxes, or she can file my taxes. If you're not sure who to go to, right? So this is just all primer, like before we get into like how to file, right? If you're doing your own research, go to those IRS websites. If you're not sure, like if you want tax help, who do you go to? As someone who has worked at the IRS and an international accounting firm and now a global bank, I would always, and has done estate and tax planning, I would always, always, always recommend that you go to a CPA first. Why? Because first of all, a CPA does taxes, right? They're a certified public accountant. That means that they have a business license to help the public do accounting. Okay, that is their purpose, is to do public accounting. They had to pass a very complicated test that takes years to pass to answer your questions specifically about accounting, no matter how complicated. They tend to have lower fee rates. Attorneys are going to charge you in 6-minute increments that tend to be a little bit higher. And attorneys, let's be honest, don't study accounting. Most of them go to law school so that they don't have to do math ever again. But there's some wiggle room in the law that allows attorneys to file tax returns. And it's just a really good way to like augment the income for their practice. And so a lot of attorneys get into filing tax returns, even though they're not necessarily tax attorneys, or that's not necessarily what they went to school for. Although there are certain situations where it's a great idea. Like if you have a complicated trust situation, you might want an attorney to file your tax return. I recommend that you go to a CPA first. Why? Because if the CPA screws up, then you go to a lawyer. And then you have the lawyer double check what the CPA did, right? And then you have two fiduciaries battling it out against each other as to what is in your best interest. If you go to a lawyer first and then you have another lawyer double check them, you're paying 2 rounds of legal fees. I speak from experience on a case. I was one of the lawyers that had to argue as to why my client should not have to pay double legal fees for when another attorney was filing her tax returns. It was very upsetting to her because they did not file her tax returns correctly. Okay, so if you need to find a CPA, how do you do that? Well, you go to the Illinois Society for CPA Society, and boom, here you go, find a CPA now. And if you need to find a lawyer, who are you gonna call? Ghostbusters. No, just kidding. Call the Bar Association. Their number, wrong presentation. Their number is at the end of this presentation. Oh, and also in some, but not all cases, reliance upon a professional advisor provides an affirmative defense in an IRS audit. They have to defend you generally. If they don't cooperate, which often happens, the fact that a professional signed off on your tax return can work in your favor, but you have to raise that defense. You have to say like, well, I gave my attorney or my CPA all of the information, and they told me this was the best strategy. Something to that effect. There are regulations you have to cite and certain standards you have to meet, but generally that can actually like completely nullify an audit in a lot of situations, not every situation. And I'm not going to tell you what those regulations are. So you will have to ask a CPA. They will tell you. Okay. So Michelle, who needs to file?
All right, we're going basic here. And I think in large part, I wanted to go this basic is because this is something that a lot of folks don't understand off the top of their head is what the standard deduction is when they need to file. Not to mention seniors and people who have been filing for many years may be used to the standard deduction being really low, because historically the standard deduction was, $2,000, and you needed to itemize your expenses in order to get enough money knocked off of your income to make your taxes reasonable. So, but luckily, there's been changes in the most recent years to make the standard deduction more reflective of what people's actual situation is. So what am I talking about? So I'm talking on the left here, we see different filing statuses, and everything when it comes to your tax return is often based on what your filing status is. So I've listed them all here. There's single, there's head of household, which really means that you're single, but you have dependents in your household. It doesn't mean I'm the head of my household, I pay all my bills. I would love for that to be true. I have a lot of single folks who come in and they're like, well, but I pay all my bills. But what this means in IRS speak is that you are single, you are not married legally, and you have dependents in the house. We've got married filing jointly, married filing separate, and then qualified surviving spouse. This is another status that requires dependent children. It used to be called qualified widow or widower, but the name has changed in recent years. The next one is age, because everything also depends on age. Magic number is 65 for tax purposes. But when I say the standard deduction, what I'm referring to is there is an amount of money that you earn that is the first tax bracket of $0. So up to that amount, your tax bracket will be 0. And this year, for a single person under 65, that number is up to the standard deduction if they have W-2 income. So that number is $13,850. If you make less than $13,850 in W-2 income, which is to say employment income, then you won't be taxed on that amount. So in the IRS's eyes, you don't necessarily have to file your taxes if you're not even hitting that standard deduction, because you won't pay any tax on it. You likely won't get a refund, maybe though. We'll talk about that on a later slide. So they don't require it. If you don't have to pay tax, sometimes they just don't require it. That changes depending on what your age is or what your status is. So you can see as we go down the list, if 65 and older, you get a little bump. Head of household, since you've got somebody else in the house, you get little bumps along the way. The real outlier here is married filing separately. You'd think, well, that's a married person asking to be treated as an individual for the sake of their taxes. That should be matching the single one, right? Well, it does. The standard deduction for a married filing separate person is the same as a single person, $13,850 in 2023. But the threshold of requiring to file goes way down to $5. So why is that? Largely because the IRS and the Department of Treasury don't want people filing their taxes separately just to hide income. So we're trying to not have married couples try and game the system. So that's why married filing separate typically does not give you a lot of benefits. It's typically a bad status to file in unless you have a particular reason. And so that I would say, talk to your CPA about whether you should be filing jointly or separately, depending on your situation. But Michelle, what's this fourth one on the side? Why is it all $400 all across the board? Well, we talked about employment income, W-2 income. Self-employment income is a much, much lower threshold. Everybody, minimum self-employment income $400, you're going to have to file. This is because self-employment income, your taxes are not withheld. And often, if you are only making $400 in self-employment income, whoever gave you that money is not required to file a 1099 because it hasn't hit $600. So they're relying on self-reporting to determine if you have a tax balance due because of that income or not. So the easiest way for that self-reporting to happen is for IRS to require you to file a return. So that's why your magic numbers here, 65 for age, 13,000 for wage income. If you're making over that, time to start looking at if you have to file. If you're making under that, you might not have to. And then self-employment income, $400. That's the magic number. Let's go on to the next one, because this one kind of shocks people sometimes, which is Social Security. Well, I'm making Social Security. I don't need to file my taxes, right? Surprisingly, there is a threshold at which Social Security can become taxable income. And that threshold is in the middle here, half of your Social Security benefits plus all your total income for the rest of the year. This isn't about filing requirement. This is about whether your Social Security gets taxed. So less than $25,000, your Social Security won't be taxed. But remember, that's half your benefits plus all your other income for the year. Your Social Security won't be taxed, 0%. But if you start making more than that, more than 25,000, between 25 and 34,000 combined, 50% of your Social Security benefits will be taxed. And then more than 34, 85%. That's if you're any of these statuses on the left here, single, head of household, everything besides married filing jointly. Married filing jointly gets a little bit of an exception, but you can see it's not double. It's not 50,000, it's 32,000 is the threshold at which Social Security starts being taxed if you're married filing jointly. They really, really are not wanting people to sort of game the system here. And this applies to a lot of the incomes that people assume are not taxable: retirement income, survivor benefits, disability income. These thresholds apply. So it is possible that you have a filing requirement, and it's possible that your Social Security benefits might be taxed. So this is something to pay attention to, both for my non-retirees and for my retirees. Let's go on to the next slide.
And I would just add, this is
Oh, yeah.
the stuff that really upsets people. Like, if you
Right.
don't think you should have to pay taxes on it, I mean, there are some people who think they shouldn't have to pay taxes on anything. That's a different story. But if these are the items of income that people think they've already paid taxes on in some cases, which is not always true, or it technically in disability, it's actually an insurance payment. So like, you shouldn't be paying taxes on it according to some statutes. So this is one of those things that people get really emotional about. They don't think they should be paying taxes on it. So if the default in your head is, oh, well, why would I pay taxes on that? Double check. This is that red flag. Double check that.
Right. Yeah, totally true. And I know a lot of folks, if they outlive their spouse and they get those benefits of their spouse, they feel very cheated by the fact that they might have to pay taxes on their passed away spouse's Social Security. So definitely something to look into and protect yourself with knowledge in that area. But what if you don't make that much, right? What if I've given all these speeches and you're like, I am not making that much, I don't have to worry about it? Well, there are reasons why you might want to file still. If you are working on a W-2 job, you're considered an employee, and you're having income taxes withheld from your paycheck, you may want to file just to get those withholdings back. That would be your refund for the year, right? You also may want to file if you're entitled to refundable credits, which are credits that will trigger an increase in your refund versus just a reduction of your tax. So popular ones that you've heard of: the child tax credit, the earned income tax credit, sometimes the premium tax credit. And then for my college students or families of college students, the education credits, the American Opportunity Act, and that's the only one that's refundable now. Lifetime learning is no longer refundable. So the American Opportunity Credit can be refundable if you have a dependent in college, or if you have a student going to college. Then what I get a lot of times is, hey, why do I have to file? People want to qualify for social services. And a lot of times those social services want proof of income. And sometimes the simplest way to prove your income is to provide your filed tax return. So I have a lot of folks who come into our low income sites and they want their taxes filed, even though they have so little Social Security, it won't be taxed, or even though they only had a job for a month, because they want access to housing assistance, or because they have an immigration case pending. Those are times that, even though you don't have a filing requirement, it might be to your benefit to file. Student loan repayments is another way. It's easy to just plug and play and get that calculated based on your last year's taxes. And then remember our $400. If you earn self-employment income and you did not withhold taxes, you're going to want to file, because you're going to owe those taxes, and the IRS will find out. So, because it's reported. So that's one of the disadvantages is the IRS gets all these forms sent to them by people who pay you money. So you might as well cover yourself and protect yourself in advance, right?
Yeah, I would add, this is something that surprised me when I got into tax law. Your social security number is like a tracer number for you for the IRS. So it's just like a homing beacon that the IRS uses to track you through the system. So anytime anybody pays you anything that requires your social, or part of your social, that gets reported up to the IRS one way or another. Your bank, like anything that requires your soch is gonna, so a lot of self-employed people are like, oh, it's cash, this, that, and the other. It might be cash, but if somebody took petty cash to pay you, that might go into their ledgers and that might trickle up to the IRS. So I know that sounds a little like paranoid, but that is how that works. And so the best, like a lot of self-employed people that I've seen, again, as someone who used to prosecute them, like it's never too late to start working with a CPA. It really is not. No matter how bad you think it is or how anxiety inducing it is, I promise you the people on the other side of your case have seen worse. I promise you. Like there have been times, where, it has been a day before trial. I've had someone fax me dozens of pages of receipts, and that's okay. And we figure it out. And you should be treated with respect when that happens, because it's a very anxious situation. But try not to get into that situation and just start working with a CPA. That's why CPAs are so good. Attorneys may have their own pile of receipts that they have not yet filed. If you know any good attorneys. So I'm not saying CPAs don't do that. Every profession has their little thing. But just know that if you're doing self-employment taxes, if you have especially mechanics, photographers, things like that, like those things that you do is like maybe side hustles, I'm thinking like appliance repair guys. Like there's some guys that just go around fixing vacuums or dishwashers, things like that, and they charge their neighbors a little bit on the side here and there. That can really add up very quickly. And so you just find your neighborhood CPA. I don't love those franchise places that run those specials around tax time. I'm not going to toss any names out there, but those places that are like, oh, we'll give you an instant day refund, we'll just charge you 28% interest until you actually get it. Don't do that. Go to your neighborhood CPA, use the link that we're providing. It's never too late to work with a professional. They'll help you iron it out.
Yeah, and we kind of touched on this a little on what our next slide content is, but it's why might somebody surprise owe taxes, right? Why might somebody have their taxes done and it's April, you're excited for springtime, and then suddenly you're like, what do you mean I owe $2,000, right? The big one that I've been seeing lately as of last year, and then it's always been a problem, but I've just been seeing an uptick in it, is not withholding enough. If you have a job that withholds taxes from your paycheck, it's essentially like prepaying the IRS your taxes for the year. And it's people are just not withholding enough for it. So you can always, anytime, ask your employer for a new form to adjust your withholdings. That form's called the W-4 form. If you need help filling that out, please feel free to contact me at Ladder Up, or a lot of folks at Ladder Up. We are trained in how to help you with that form, especially because that form has been updated as of 2019. It looks a little different now. It used to be that you would just take an exemption, and so you'd take one for yourself or zero, or you'd take a number for however many people are on your taxes. It's changed a lot. So a lot of times too, people aren't knowing how to fill out the new form. Maybe they're filling it out wrong, and it's not withholding enough. So the next one is our self-employed folks who do not withhold any income from their or any taxes from their income. The self-employment tax rate is 15.3%. The IRS expects you to prepay this just like everybody else who's getting it with help every 3 months. These are called estimated tax payments or quarterly estimated tax payments. The 15.3%, most of it, like 8.6, I think, percent of it is your Social Security tax and your Medicare tax, the same as everybody else is paying. It just feels, it hurts more because it usually hits these folks all at once at the end of the year. And then they go, I didn't even know. And that's when I have to say, well, good news or bad news, you're supposed to be prepaying these. This is something that helps with tax compliance. And then the last one that I want to hit is something that people don't really anticipate, is penalties for withdrawing from retirement accounts early. This happens a lot when people change jobs, right? They're leaving a job they didn't even know their employer was contributing to a retirement account for them. they get notice, hey, you got $4,000 lying around. Well, you've just left a job. It's a good time you might need $4,000. But that comes along with, if you're less than age 59 and a half, it comes with a 10% penalty for early withdrawal. And it could come with other tax burdens depending on your tax rate, because it's technically considered income. So you want to make sure you roll over those funds within 60 days if you leave a job. And if you are going to take money out of your retirement, you're in a hard situation, you really want to talk to your CPA or the retirement company about what your exact tax burdens are going to be. Sometimes they can withhold it from your retirement, even if you're taking it out for hardship. There's also exceptions that exist. Buying a house for, I think for first-time homebuyers, for certain disaster zones per year, and then some illnesses and disability. So if you think an exception applies to you, this is another thing to look on the IRS website or talk to a CPA about. If you're really hard up and you're needing to tap into your retirement, do your research on that and do it from trusted sources like the IRS website.
Yeah, and I also, just to tack on the penalties to really scare everyone, the self-employed taxpayers, penalties exist for everybody. One of the hardest things, that you see in tax court or in general at any level with the IRS is somebody who didn't pay their taxes on time. There are penalties for timeliness that cannot be waived. Even if you go on a payment plan, it's a jurisdictional statutory issue, which means it's written into the tax code. And the judge, if it goes all the way to a judge, which there's a 99% chance you'll resolve it before you get to a judge. But even if you take it all the way to the judge does not have the power to get rid of your penalties and fees or interest. So, some of them he can, in very rare exceptions. But a lot of people don't even know that if you miss a payment, penalties and interest start to run. And unless you hit a very rare exception, which is like, my CPA told me this was okay, and I can prove it. Here's a letter from my CPA committing malpractice, right? Or your CPA writes a letter and says, dear IRS, mea culpa, I made a mistake. Please don't charge my client this penalty and interest. So unless your CPA is willing to fall on their sword, you're going to get charged penalties and interest that run from the date your payment was due, not the date you learned that you were supposed to make that payment. So if you find out, and there's no statute of limitations on some of that. So like, I was supposed to pay that, let's say 6 years ago, penalties and interest running for 6 years, right? And if you don't file a return, there is no statute of limitations that applies, right? It just stays open. So if you had income from 20 years ago and you never filed that return, you could potentially owe penalties and interest running for 20 years. And no one at the IRS can waive it, barring, I think it's literally like, a loss of, sanity. Like you literally were. Yeah. So, so just go to a CPA. It'll be okay. And whatever you think it is, it's not that bad. They'll fix it. But get out ahead of it. And if you fall behind, it's okay. There's millions of people who fall behind every year. And the IRS has a lot of ways to help people who fall behind. So just be aware that there are penalties and interest that apply for everything. You are not alone. There's a lot of people who go through it, and there are ways to get through it. Let's throw those penalties away.
So while we're on the topic of retirement, this is a common question, and this is something that kind of tends to change every single year. So everybody's always clamoring like, what are the contribution limits going to be? So, regardless of the type of retirement account, like if it's traditional or Roth is really what I'm referring to, is you're allowed to contribute a certain amount to that retirement account before, the IRS is like, whoa, hold the phone. Why so much? So that amount for 2023 was $6,500 for IRAs, traditional individual retirement accounts, and Roth individual retirement accounts. It's going up by another $500 for 2024 to $7,000 before you start owing penalties, and you have to pull it back out. If you're over age 55, I think it's 55, the catch-up provisions allow you to take an extra $1,000. So for my folks who are headed towards retirement and not feeling quite comfortable for 2024, they'll be able to do $8,000 into those IRAs. 401ks, so employer sponsored programs, 401k, 403b, and thrift savings plans. Those contribution limits are much higher, $22,500 for 2023, and then going up to $23,000 for 2024. And the catch-up provision is also higher, so $7,500 in addition for catch-up if you qualify for that based on your age. Simple plans, which are employer-sponsored individual retirement accounts, have different limits for some reason, but those are $15,500 for 2023, and then up to $16,000 for 2024. Smaller catch-up than the 401ks, though, $3,500 going forward. So while we're talking about retirement, I also wanted to hit on we'll hit on a series of popular tax credits that you can take, but this one is the retirement saving contribution credit, the savers credit. This is a really unsung hero of the tax credit universe. A lot of people don't know about this credit. It gives you a little bit of a break on your taxes for contributing to retirement if you are considered low income or lower income. So this one's a little complicated because it gives you a certain percentage of what you contributed based on your AGI, which is your adjusted gross income. So it does phase out when you make what is deemed to be too much income to be considered low income anymore. But so just to walk you through the chart, but you can follow this chart for your own situation and see if you qualify. So you get a credit of 50% of your contribution if you are married filing jointly and your AGI, your adjusted gross income, is $43,500 or less for the year. So what we're trying to do is incentivize contributing to retirement accounts for low income folks here. The phase out for married filing jointly is $73,000 of adjusted gross income for the household. And then the phase out for our single married filing separate folks is $36,500, which is relatively low in today's income. Like, I think nobody would dispute the fact that that's a very low income, but that's why we're just trying to incentivize that. So if you are low income and you're thinking, oh my gosh, I didn't do my withholdings right this year, you might be able to alleviate that a little bit if you do want to try and put a little bit into your retirement. So, and it's gone up. So that's the exciting thing too. Hopefully we'll keep it going up. We can go on. So more popular tax credits. The one everybody loves the most, the child tax credit for my families out there. So we had the child tax credit went through a lot of changes during the pandemic, and we've kind of leveled out back to what it was prior to the pandemic. So $2,000 per child under age 17. And when does that kick in? On the last day of the year for 2023. So if your teen turned 17 on December 30th, you don't qualify anymore. But if they're less than that, you get it. The refundable amount, which is also known as the additional child tax credit, increased to $1,600 per qualifying child, increased by $100 compared to last year. So the child tax credit is generally a real good refundable credit for families out there who need the support. Child and dependent care credit, another sort of unsung hero credit. People don't know that if they need to pay for childcare in order to work for their child dependents, or even for an elderly member of the household, if you need to pay for elder care in order to work or look for a job, you can take some of those expenses on your taxes and get credit for them. So if you have one dependent in the household, it's up to $3,000. And here the employment related care means that it is letting you, the taxpayer, be employed. That's that standard. If you have two or more dependents, you get up to $6,000. This one is not refundable. So what it does is it reduces your tax burden so that you can get more of what you've already withheld or paid for towards your taxes, or more of that child tax credit refundable. So it reduces the burden. You won't just get a $6,000 check based on it. Your dependents have to qualify for this. And so this is, again, where I would direct you to your CPA or to the IRS website to check whether your dependents qualify for this. The next one is the other big one that they love to talk about at the IRS, that the politicians love to talk about. This one's called the Earned Income Tax Credit. A lot of people might have heard of this one before. This credit was designed to alleviate some of the burdens of poverty. And this credit is fully refundable. So this is why this is sort of the rock star credit. When the pandemic was happening and in the law, they allowed for folks who file married filing separate to claim the earned income tax credit. And that was that kind of held over longer than most of the other pandemic regulations. It held over into 2022 tax season. It is no longer the case. So now people who are filing married filing separate no longer qualify for the earned income tax credit. You have to file married filing joint, single, head of household, or a qualified surviving spouse in order to qualify for this credit. Something to just add here, which is that during the pandemic, they eliminated the age restriction on this credit, but now they've brought it back. So folks who are older than 65 are not able to qualify for this credit. If you're younger than 25, technically you're also not able to qualify for this credit. The assumption there is that folks who are less than 25 are not fully independent. They may be relying on other people. They may be going to school, so they won't be earning as much as they could if they were full-time. But there are some exceptions for the folks who are younger than 25 who might be able to claim this credit. One is if you're a foster or a homeless youth, and one is if you are married and have dependent children and you're younger than 25. Anyway, what's the maximum AGI? How do I get this credit? This depends on how many dependents are in your household. So 0, 1, 2, 3, and more, right? If you have 0 dependents, you have to have an adjusted gross income of less than 17,640 this year. It did go up. This one kind of increases in weird ways. It's not consistent across the board. So for my non-married folks, 17,640. Once you pass that with your AGI, you're not entitled to this credit anymore. And then it can change based on your filing status or how many dependents you have in the household. If somebody is a grandparent who's taking care of grandchild dependents, you might still qualify for this one depending on your income. So that's the change there. We've had like a big increase to our 2 and our 3 dependent households, minor increase to our 0 and 1 households. All right, let's go to the next one because there's more on the EITC. So, which is the amount of the credit, right? Oh, the other change was they used to disqualify you if you had investment income of over $10,300, and now that's gone up to $11,000, which is good, but comes with its own special challenges. But how much could you get as part of this credit, right? So in 2022, the maximum, this scales also with your income and with specifically your earned income, because this is the earned income tax credit. So if you had no dependents, the maximum you could receive in 2022 was $560 as part of this credit. Remember, that's refundable, so it would come back as part of your refund. They've raised that a little bit for no dependents to $600, but they've raised it a lot for some of our other. They've raised it by like $300 for one dependent, and then 3 or more, you can see that was raised by about $500. So they're trying to increase this with the crazy rate of inflation, but things are a little bit slow to move, right? Anything you want to add about the earned income tax credit, Genevieve?
Yeah, I would just say that there was a Stanford study recently, I believe, about the earned income tax credit that got a lot of news. It's pretty controversial about the audit rates for the earned income tax credit and how it plays out across the country with different demographics. And we're going to have a panel on that in February. And Michelle has agreed to speak on that as well, just because she's awesome, but also because we want to have a practical discussion, right, for Chicagoans about what that looks like. But suffice it to say, a lot of people are up in arms about the earned income tax credit being audited. Not the credit itself, but the way it gets audited is very controversial.
Right. Very exciting. So we've always been able to take a little bit of credit for certain energy related investments or property acquisition or things like that. But oh my gosh, I get all the bills confused. So I'm not going to try and name this one, but the recent climate change bill that they passed last year, I believe, created a ton of new energy credits that can be claimed by individuals instead of corporations, which is kind of like a big change. So this year is the first time you'll be able to claim clean energy credits for, in this case, for this one, but we're going to do a bunch more. The installation of energy efficient generation for your household. So solar panels, water heaters, fuel cells, wind turbines, and I don't mean necessarily the big, huge ones, but they make little tiny wind turbines too that you could put on your roof, heat pumps, battery storage. If you install those into your residential home, you can get a credit for that. And then we have some more on the next slide, which are going to apply to more folks, which is energy efficient home improvements. So they've created some credits for increasing the energy efficiency of your building envelope, which in this case means doors and windows and insulation materials. This is where we kind of get like really in the weeds, but they allow for certain costs, up to 30% of the costs. For this, for the building envelopes thing, doors, windows, insulation, it does not include labor costs. But for the rest of these, it does include labor costs as something that you can get the credit for. And a lot of them have caps. And we'll have one more slide about how to determine if any of these actually qualify as energy efficient. Like, how do I know if a door is energy efficient, right? There's a guide for that. But in this case, like up to $500, up to $250 per door, up to a total of $500 if you install energy efficient doors, which is of course going to help with heating and cooling too. So that's why it's trying to do the incentive. They also have it for home energy audits. If you want to see how much your home is using in energy, 30% of costs up to $250. The audit has to meet certain guidelines. That means residential energy property improvements to your air conditioner, installing a new air conditioner, installing water heaters, installing new furnaces and new hot water heaters. These are things that are like huge expenses for a normal household that now you can get a little bit of a tax credit for if you make the effort to get an energy efficient one installed. For this one, labor cost is included. So this is also where I'm going to say, start saving your records. If you're doing improvements, start saving these records. Save your receipts for the labor. Save the receipt for the door, or save the receipt for the furnace. Don't throw it away. Shove it into your tax drawer instead of just the drawer in your kitchen where all of the little books go for everything you buy. It's like my kitchen. So save those now because they may be relevant on your tax return. That's something to take to your CPA and say, hey, did this qualify? The other thing is, now that you know, when you're buying those doors or when you're buying those windows, you now know to go to the IRS website and see if the door you're buying is going to qualify to give you a little bit of the $250, right? Final thing, heat pumps, biomass stoves. I don't think that's going to apply to a lot of our city and suburban folks, but it is worth saying 30% of costs, including labor. Let's go to the next one. We got a little bit more on residential, right? So what is the max? Previously with energy efficient credits, there was like a lifetime maximum. Now they've changed it. So these credits that we talked about, it comes to a $1,200 yearly aggregate maximum, right? So your envelope components, your furnaces, you can go up to $1,200 yearly. Heat pumps, biomass stoves, and boilers have a separate aggregate of $2,000. So if you were to like do this strategically, you could get up to $3,200. I don't think that people are going to do that, but you know, who knows? Sometimes everything goes wrong at once in one year. So, and there's no longer that lifetime limitation. It's now just this yearly aggregate limit. How do I know if it qualifies? That's all I care about. So we're going to refer to IRS website. If I wasn't sure if we would be distributing this, so not only did I include the link, but I also included the keyword to search for. So go to irs.gov and search for energy efficient FAQs, and it'll give you the guide for where to navigate to determine if your exact thing is going to qualify for this credit. And then cars. This is the other sort of hot commodity, right? Electric vehicles. They've given another tax credit for it. Used to be back in the day, there was a tax credit, I think, for hybrids, and then there became a tax credit for some plugins, but it was kind of weird. Now we have very clear boundaries on it. So it has to be perfect personal vehicles. It has to be used in the United States. These are plug-in electrics, not hybrid, right? There's a maximum of your income to qualify. So max adjusted gross income for married filing jointly, $300,000. For single filers, 150. For head of household, 225,000. The amount of the credit varies depending on the vehicle and depending on when you placed it in service. That part can never be simple, right? So if you bought it before April 17th of 2023, $25,000 is the base amount of the credit, and then it can go up to $7,500 depending on what your car's specifications are. If it was bought after April 18th, which those in the know is filing day this past year, if it was bought after filing day, it depends on mineral requirements, battery components, and then if it meets both, up to $7,500 again. How do I know if my vehicle qualifies? That's all I care about, Michelle. Fueleconomy.gov. This one, they gave me a nice little clean URL, fueleconomy.gov. Love it. If you're going to buy a car, if you're thinking of plug-in electric, go ahead and look. Hey, is my car going to qualify? Am I going to get the credit? Definitely check that. So anything to add on those energy credits, Genevieve?
Just that I know a lot of people are worried about them. Most importantly, my mother, she was persuaded to buy a plug-in vehicle earlier this year and has not stopped asking me about it since. I would say go for it, right? Obviously, this is the best thing for the environment. Make sure that you don't just do it for the tax incentive. Make sure that you plan your routes and you actually have places to plug in your car. I do believe there are some incentives either through certain dealerships or perhaps tax local incentives based on your state for installing the plug in your house as well, which is another question my mother has asked. So there are certain localities will provide certain things as well. So if you put something on the outside of your house, versus on the inside of your house, sometimes they like that. So a stranger can potentially plug their car in on the outside of your house. So things to think about if you're really into it.
Right. Yeah, definitely do your research on it. And I guess the final thing I thought of was I had a client recently pull me aside at the tax site and say, hey, I want to claim an energy credit for my refrigerator. And I think you'll notice here that I did not say refrigerators on this list. Unfortunately, I didn't say dishwashers. I didn't say ovens. And so this is not going to apply to every single improvement you do to your house. If some of those really suck and are burdensome, you know, if you got to do foundation or you had flooding or something, the energy credits are not for that purpose. So definitely look into it when you're doing those improvements.
Yeah, they're for narrowly tailored environmental improvements.
Right.
Yeah.
Always important to talk about what's expiring, because this is something people don't really know, which is that refunds that you are entitled to expire. So they only last for 3 years. Some exceptions. I'm an attorney. I can't say anything, you know, except for asterisk, don't worry about it. So 3 years. So if you haven't filed your taxes, if the pandemic got away from you, 2020 refunds will expire this filing season on filing day, April 15th, 2024. So if you didn't file your 2020s, definitely get those filed within this tax season. That's something that Ladder Up is going to do at our VITA sites. The expiring year, we always cover. Any CPA would be fully understanding that the 2020s got to get in before the refund expires. The other thing that makes this even more important is the 2020 refund expiring will take with it the recovery rebate credit. Now, what is that? You didn't talk about that. That was the stimulus. The stimulus payments received in 2020, also known as the economic impact payments. It was $1,200 for adults for the first one, $500 for dependents for the first one, and then $600 per person for the second one. If you did not receive the stimulus, the only way to claim it was to file your taxes and claim the recovery rebate credit. You could get your stimulus back as part of your refund. If you didn't do that, if you didn't get the stimulus and you didn't file your 2020, you're still entitled to the stimulus. You got to file it before April 15th. If you hit April 16th, 2024, and you still didn't do it and you didn't take any action about those asterisks I mentioned, it's gone. I cannot get it back for you. So please, please, please file your 2020 taxes if you did not, especially because those years were gangbusters for refunds. Go ahead.
So Michelle, if I did not file my 2020 tax return for my refund, or let's say I didn't file my refund, because you can file a tax return and not get a refund. You can, okay, let's say I didn't file my 2020 refund and I am prepared to file my 2023 tax return. Is it should I be like, well, I'll just focus on my 2023, or would it be better for me to just file my extension for my 2023 and put my energy into 2020 before April 15th, 2023?
You're exactly right. It would be if you file a timely extension, which is to say before April 15th, you file an extension on 2023, no impact to you. If it's an accepted extension, your refund's not impacted. If you owe money, you're not hit with those penalties or those late filing fees. You're not hit with any of that. So it is absolutely better to file an extension for 2023 and focus on getting that 2020 in before the expiration date. No extension will save you from that expiration date when it hits that time. Those asterisks I talked about, those are not extensions. Those are other things that
Yeah.
the 2020 will expire.
Yeah. So 2020, no extension available. You're done. You're cut off. You're cut off.
Right.
Right. For 2020 as of April 15th, 2023. But your 2023 tax return, you can extend for another 3 years, if I'm not wrong. So not that
Right.
we recommend it, but go ahead and file that extension. You don't have to wait until April 15th to file that extension. I believe you can file it as soon as January 1st. I could be wrong about that since it's been a while since I've been on that side, but you can file an extension well before the due date.
Well before the due date, but I would say that e-filing doesn't open until late January. So I would wait until e-filing opens, which is to say filing stuff online. So I would say if you know this is going to be a problem, February 1st, file your extension.
Yeah. And then just focus on 2020, finding those records, put your energy into 2020.
Right. Free resources. And I know we're at time, so I can kind of speed through these a little bit. We talked about VITA. VITA is the Volunteer Income Tax Assistance Program. Trained volunteers using IRS training programs prepare your taxes. There are income thresholds on this. Generally, it's about $60,000, but that depends on the exact VITA you're using. For Ladder Up next year, it will be $63,000, whether you're single or you are head of household or married filing jointly. $63,000. Up to that amount, you can come to our VITA. Social Security, we do not include when we're evaluating that whether you qualify for our VITA services. So we are only qualifying your earned income or other investments or whatever. There's a locator tool on the IRS website to find a VITA near you. It's not always going to be Ladder Up. There are a lot of AARP VITAs or AARP tax services. There's also tax clinics for the elderly, which also will prepare taxes for free. So I would say use that locator tool. If you think you qualify, contact the nearest one near you and see if you qualify or if you need an appointment. Ladder Up's a walk-in service, but not all of the VITAs are walk-in. And all VITAs and TCEs and the AARP services are free. You will not pay to have your taxes prepared. They are free. We can go on.
And they're federally funded generally, right?
Not always. Some of the education related ones like Notre Dame's VITA is not federally funded, but it's still free. A lot of them do get the VITA grant. So the IRS is paying for it to remain free for you. The IRS free file program. So what if you make more than $63,000? You can't get Ladder Up to help you. You can't get a VITA. The VITA near you has a lower threshold maybe. So IRS free file program, AGIs of less than $73,000 can file for free using official tax software, but it'll be self-preparation software. So this is where you can use your TurboTax or your H&R Blocks online program for free. So the only way that it is triggered, though, is by going through the IRS website to get to that. You can't just go to TurboTax and say, I would like to do it for free, please. They're still trying to make money. So go to the irs.gov website, search for IRS free file. The other thing is the IRS website will offer a way to prepare your taxes on their website platform this year for the first time. So you could experiment with that as well. We're all very excited about it, but it will not file your state taxes. You will still need to file your Illinois taxes or wherever you're located. So keep that in mind. And then final shout out, which is my tax clinic, is a low income taxpayer clinic and LITC. This is another federally funded program. As I mentioned at the top, if you have a problem with the IRS, if you have a controversy, if you're getting audited, you can contact an LITC for assistance. Qualifying for services where we'll handle it for you depends on the clinic. So always call and ask, and they will ask you some questions to see if you qualify. But we can always give consultations. Even if you don't qualify for our services where we handle the whole thing for you, you can get a consultation from any LITC So please don't hesitate if you got a tax problem or a tax question, contact an LITC. I've included the link for where to find them, but it's on the Taxpayer Advocates website, or Genevieve mentioned it's also included in a lot of the publications the IRS puts out. So you'll be able to find an LITC even if you go to irs.gov and search for LITC. And I think that's it, and we're on to questions.
Yes, a quick question just to clarify. We have here listed an attorney, a CPA, or an EA. What is an EA, an enrolled agent? Do you want to clarify
Yes.
that?
An enrolled agent is somebody who has taken a number of tests through the IRS to be able to practice in front of the IRS the same way a CPA or an attorney would. They are extremely trained. These tests are very hard, and they have to take 3 of them, like the bar exam 3 times. So the EAs are a great resource, similar to CPA. They are tax experts, and so I'd never hesitate if you want to get your taxes prepared and the person is an enrolled agent. They absolutely know. They are trained in tax.
I could be wrong about this, but I heard the EA exam was designed for like retired IRS agents to be able to practice privately. So often EAs will be like semi-retired tax professionals that may have had a government role. Like that's been my experience. Like EAs are either paralegals that are basically retired or former government agents. So they're very, very practical people.
Yeah.
Yeah. Okay.
All right, so we do have some questions lined up here, and if you do have another question that you're thinking of, please add it either to the chat or you can add it to the Q&A section at the bottom of the screen there. So our first question is: a CPA files my taxes. I receive materials to review and sign. It's hard to know what I'm actually supposed to be looking at. So the numbers are reviewed, but I'm not sure how I would catch an error. Are there any items in particular someone should pay attention to in that situation?
I'm happy to take that if you want.
Yeah, go ahead and maybe I'll add in.
Great. So that's where the affirmative defense for a professional tax preparer comes in, because there is actually a very important case in the history of tax law that says that you, as a layperson, are not expected to know how or when to question a tax professional because it is too complicated. That is the law. You are not expected to know how to question them. However, you are required to know what is on your tax return. You cannot say you did not look at it, and you have to make sure that all of the numbers have a basis in reality. So you can't say like, I don't know, I deducted 2,000 pounds of cheese and I'm no. Okay. And I'm not even a cheese salesman, right? Like you can't do that. You have to be able to back up anything that the IRS can question anything, and you have to have an answer for it. So that's just the way to think about it. Your CPA isn't going to have those answers. Your CPA is probably going to say, I went to my client and they gave me information that I based this filing on. So you better have something to back up all those numbers.
So yeah, and I think so my 2 cents there is when you're looking at those numbers, if something seems really crazy, like you're like, hey, my salary is 75,000. But this number says 260,000. That's what I would want you to look up for. The other thing is, absolutely do not hesitate to say to the CPA, hey, can you walk me through this? Hey, I don't know what this means. Can you walk me through this line, this line, this line? They should be doing that. If you are asking like, hey, can you explain the taxes to me? And this is something we do at the VITA and went on the exit. So when we're done with the return, we print it out and I actually go line by line and explain to people, this is your wages. This is your Social Security. This is the tax that was assessed. This is what you withheld. And this is how we got this number. And if they're not willing to do that, you might need a new CPA.
Yeah. So we were actually just talking about this earlier today, right? A lot of people will say like, oh, well, taxes are really complicated and I'm just like super smart because I'm a tax professional. There is that attitude, right? In tax professionals that exists. Okay. And if anybody treats you that way, walk out the door. Just that is not an acceptable way to treat a client, whether you are an attorney or a CPA ever, and especially not in tax law. Because at the end of the day, tax is addition and subtraction. There's a number that we start out with. Usually it's your income. We added up all your income. And then we started subtracting, right? We subtracted, we gave you credit or deductions from your income for certain things that you did, like making your home more energy efficient. Your income was $100,000. We took off 20 grand because you, I don't know, bubble wrapped it. I don't know. So, right. Like, but it's simple. It's $100,000 minus 20. We get to 80. Okay. Then we're taking war. So anybody that's like, it's complicated. It's really not, because every time you take something off, there's a schedule for it, which is just another sheet of paper with a little bit more subtraction on it.
Where they have to show their work.
Yeah. Every tax return, you have to show your work. So again, as somebody who has worked at an international accounting firm, a global bank, the IRS, if they cannot prove their math, they are in trouble. There's no excuse.
Yeah. So
Yeah.
just ask.
Yeah. And they should walk you through it. If they're not, they're being weird.
Yeah.
All right. So for SSI, in terms of the percentages, how do those factor into when you decide to take SSI? It seems like you would like this to be lower annually, which would lead to taking SSI earlier. Do you have any opinions about when you start taking SSI in terms of its impact on your taxes?
I would say that's a really personal decision. And that's something that you got to look at for how you're going to structure your household. And so as far as if your goal is tax structuring and paying as little in tax as possible, you're going to make a different decision than if your goal is to have sort of a little bit more help to cover your mortgage or your rent, right? So I would say in that respect, look at the percentages that get taken. Look at whether you plan to retire and maybe have a little part-time job or a side gig or something, and make your decision based on that. There's also a bunch of other retirement considerations that should factor in too. One is called required minimum distributions, which you hit when you're 73, I think.
It used to be 72 and a half, but it might have gone up to 73.
I think it's about to go up. So required minimum distributions are when you have to tap into your retirement. They don't let your retirement just kind of sit there. And I don't mean your Social Security, I mean your retirement. So I would look, that's like a question that I just can't answer unless you have a holistic look at both your entire retirement plan, including your SSI and your goals. So as much as I would love to play financial planner here, it's kind of something that is really dependent on your situation.
Great.
Yeah.
Thank you very much. All right. Is there any more information that you can share about the IRS and its own portal for tax submission? I know you mentioned in one of the slides that they have one for people who are making $73,000 and under. Is that sort of where they're planning on staying? Are they continuing to work on that? Any other information on that?
I actually haven't. We've all kind of been eagerly awaiting this in the at least in the legal aid world, the side of tax, we're all like very excited. But I don't think they've even published like a mock version of it yet. They're being really kind of hush hush about it as they develop it. So I can't really give a lot more information. I think it's much like everything, right? It's the first year of it. It's probably going to be really good at simple returns. It's probably going to be really bad at super complicated returns with, like, if you're coming in with a trust and with investments and with crypto, it's probably not going to do a great job at all of those things quite yet, simply because it's the first year that it's in existence. If you are coming at it and you got Social Security and you got one W-2, it's probably going to knock it out of the park, right? It's probably going to do really good at that. So I would say keep an eye on the IRS website if you're really interested in using that tool as they sort of publish developments. It probably will not go live until late January at the earliest. And, proceed with caution. If something feels weird about it, like the numbers aren't adding up, like Genevieve said, then you might be better off going to a Vita or CPA, especially if your situation is more complicated. If it's not, and you're paying somebody $200 to file your one W-2 return, this is probably a great resource for you.
Yeah, and let's take two additional comments to that. So first of all, you know, if you're wondering whether or not you're going to qualify, like, oh, I make $74,000 a year. Lots of times those limits for free filing, they follow certain tax brackets and when certain tax credits phase out. So a lot of tax credits when you study tax and accounting, a lot of things start phasing out between $72,000 and $78,000. So 73 is like right in there. So watch those numbers. It's probably going to go up in the next couple of years. So you might qualify if you're hovering around that number. So if you don't qualify this year, you might qualify next year. I hope you don't. I hope you don't qualify, but if you do, right, that's, you know, that $73,000 is still a lovely income to make. You know, I hope you do, right? So watch that. To Michelle's point, to echo that, you know, what is a reasonable fee? A lot of people think like, oh, a CPA, like, oh, that's going to cost a lot of money. No. You know, I don't know I'm not going to quote a number here, but a lot of CPAs, I would respectfully suggest that you should not be paying $200 for a single W-2 return. Most, you know, I feel passionately about that.
Me too.
Most, I'm not clumsy at all. Most, you know, neighborhood CPAs, not those big national franchises that give you the, you know, same day refund. But a lot of those, you know, your neighborhood Smith and Sons CPA will, you know, they'll charge you a very reasonable fee for a relatively simple return, and even something that's more complicated. I can tell you from personal experience, 10 years ago, I did, you know, I went to my first CPA for a return that was relatively complicated for me, and I think they charged us $150, and we sat with them for like 2 or 3 hours. Now that was 10 years ago. But you know, that's what that was. And there was, you know, we were married and double income, and my husband was an immigrant. And so it was, you know, relatively, you know, and he was a contractor. And so we had a bunch of different forms of income, and we really didn't know what we were doing. And and that was several states away. So don't use that as a frame of mind, but just know that like $200, just like if somebody's like, oh, we'll do your taxes for $200, $300, $400, like,
Shop
no.
around. I mean, much like you
Yeah.
would with anything. I hope. Shop around and ask what they're going to charge. They might ask like, how many forms do you have? And that's probably a good sign, right? If they're going to scale it based on how complicated your return is.
Yeah. You always want to get at least 3 quotes, right? Like some people are like a Toyota, a Mercedes, and a Ferrari, but for CPAs, right? And you said you don't need to pay for a Ferrari if you have a Toyota version of a tax return.
Yeah.
Yeah. Some people need a
Great.
Ferrari. I hope you all do. I hope you all do.
One of the participants commented that they have used an IRS certified person, not a CPA, who has to pass a test on the IRS laws, and that they cost less. I assume that might be a VITA or an EA that you discussed earlier. Does that sound?
It sounds like an EA.
Right?
Yeah. All the VITAs
Yeah.
are going to be free. So that sounds to me like it's an enrolled agent. Mm-hmm. And that's a great point, is that EAs, enrolled agents, will typically charge less. So if you can find an IRS certified enrolled agent, and the list of all of them, I think, is on the IRS website. Like they do keep a list of all the certified EAs who have kept up, because they also have continuing education requirements. So they have to stay sharp. So yeah, great resource. I love EAs. I'll praise EAs all day. So definitely use that.
Yeah.
Great.
10 out of 10.
So in the section on tax credits that you talked about, for the retirement ones, do those apply to IRAs or to any type of government retirement accounts? I'm sorry, I don't have more information than
That's
that.
Okay. I think we're probably talking about the savers credit, right? The savers credit does apply to a lot of retirement types. I don't think any in particular is excluded. So the savers credit, if you're in that income range and you qualify for the credit, otherwise you should be good to receive that credit. The contribution thresholds we talked about are the only things that change based on the type of account. So you'll probably want to search, if I didn't cover what your account type is, you'll probably want to search IRS website. But since they referenced a government funded account, my thought is it's probably a 403B or the TSP, thrift savings plan account. And those will qualify for the retirement savers credit. And then they have the thresholds associated with the 401k, which was that middle one, like a pretty high in the 20,000s for contribution limits.
Mhm. Great. Do you need to file taxes if you get veterans disability payments and are VA benefits taxed?
This one I don't. Maybe Genevieve, you know off the top of your head, but I think that probably some or one of those is not taxable, but this is something that I would probably have you check because the laws change every single year.
Yeah,
Um,
and I don't know off the top of my head either, but I wouldn't be surprised if it was like taxable in part, you know, like, and it's going to depend on what kind of benefit and what sort of payment it is, and like, are you getting it as the beneficiary of a veteran, or are you the veteran? Is this a deferred compensation from your time in the military, or is it, you know, something the military owes you because it's a disability arising, and like, when did that disability arise? Is it, you know, a conflict situation like that? That all impacts how they treat it, unfortunately. And I only know that not from my tax experience, but because working in the government, I worked with a bunch of veterans, and they talked about that stuff. So I just know that it's very, very specific to
But I have
how
good
that
news
arises.
too, which is that there's VITAs, the Volunteer Income Tax Assistance Program, that are specifically tailored to military. There's military VITAs, and they're often on bases. And you have to get a different military IRS certification, like the one I talked about where they're all certified. There's a military specific one that you have to get if you're going to be helping service folks or veterans. So I would recommend you reach out to nearby bases, or maybe through the VA, they may even have a list of what are going to be those military certified VITAs that you could go to. And they would absolutely be able to tell you if you need a file or not, and they would likely do it for you.
Yeah, and thank you for your service.
Yes, thank you.
Yeah. Great. Do you recommend TurboTax software for filing?
Loaded question. We love a loaded question. So do I recommend TurboTax software? Genevieve probably follows the same thing as me, which is I work for an organization that gets a bunch of grants, and I'm not allowed to recommend specific paid preparers or paid services. That being said, anytime anyone is self-preparing their return, it is a risk because you are likely not a tax professional. Right. And Genevieve talked at length about the protections that you get if somebody is a skilled preparer who prepares your return. TurboTax, as pretty and fluffy as it is you preparing your own return. So with that being said, the question of the software aside, do I recommend preparing your own return? You're not going to get the protections you would if a professional did it. If your return is very simple and it's not a problem, then go for it. But you know what you're losing now, especially because of this presentation. So if you get audited, you're responsible for what you put on that return, whether you understand it or not, right? You signed it, you agreed to it. So would I endorse any particular brand of software? Unfortunately, I can't. But do I endorse preparing your own return? Depends.
I would say I
right.
don't have any restrictions on what I'm allowed to endorse. I'm just not going to do it. No, usually I do. In this one particular situation, I don't have any restrictions. But I'm not going to do it because I don't want someone to say like, well, Genevieve said Tax Act is really good. I have friends who have used Tax Act, and they love it. I have friends who use TaxSlayer and they love it. I have friends who use, what's another one? Like I've heard, I've looked at all of them. I know that some of them offer upgrades where you can have a CPA review your, tax preparation with you. I wonder if that comes with audit defense. I know that some of them come with an audit defense package that you can buy for $79.99 or whatever. I would suggest that if, you're going to do $79.99, that's pretty close to $100. So you may as well just walk down to a local CPA or call a local CPA and get a quote, and see like if they ask you how many forms you have, or they might say like, well, how many W-2s do you have, right? And for that, like I would rather, it being me, right? Personal preference, I would rather, for an extra $30, sit down with a human being, look them in the eye and say, what is this number here? And why does it look like this? Instead of just going like, I'm gonna roll the dice, you know? I think that's a much better value for my money. But that's a very personal preference. I will say all of those softwares are, they do have to be if they're filing with the IRS, they do have to meet certain quality standards with the IRS. So you're not going to get, if they offer e-filing, the IRS does do quality checks for them. So you're not necessarily going to get a bad product. They're all pretty much the same.
All right. And then we've talked a lot about the VITAs and some of the other programs for tax preparation. Just for people's, memory and purposes of finding them, can you spell out or give the full name again of the service that people can look up? And how do you find a location?
Sure. There's a few. So I'll go back through them. So Volunteer Income Tax Assistance is the VITA that we're referring to. Oh yeah, we can back up. So VITA, Volunteer Income Tax Assistance. There's a locator tool on the IRS website. So if you go to the IRS website and you go to their search bar and you put VITA, you'll find that locator tool. Another one is Tax Clinic for the Elderly, I think is what it is, but it's called TCE. And so same thing, if you go to the IRS website and you look up TCE, you'll be able to find it. I have the little window with my own face over it. Tax Counseling for the Elderly. Very good. So TCE, Tax Counseling for the Elderly. AARP, which everybody generally knows because it's benefits it's like a little club for everybody 55 and older, or if you're my dad, you get in 10 years early because you married somebody who's 55 and older. AARP has their own tax preparation assistant. So you can go to their website, which I believe is aarp.com, and you can look up their tax aid. They also do kind of fancier stuff than VITA does because they deal with so many retirees. So they handle a bunch of exciting retirement strategies and things. Those are all free, although I know AARP is appointment based. And then the last one we mentioned the free file, which is going to IRS website and putting in free file. The last one was if you have a tax problem and you need legal help. That one is what I do, which is the Low Income Taxpayer Clinic, which is LITC. And you can search for Low Income Tax Clinic or LITCs to find locator tools. That's under the umbrella of the Taxpayer Advocate, which we won't get into. But going to irs.gov and searching for LITC, you'll be able to find links to that locator tool.
Great. And we will be sending a copy of these slides to everyone who has registered for this program within the next couple of days. As soon as we get the slides from our presenters and then we get the video posted to the website, then we will send that out to all of you who have registered. So you'll have a copy of both the slides and the video if you want to review it or if you want to share it with someone else. Are there any other questions? And if so, can you type them in the chat? Oh, wait, I see we got a couple who popped in here. The LITC and VITA are the same people or are they different?
Good question. So in my case with LadderUp, we have a LITC and a VITA, but they are different programs. And so often you will find somebody who is a VITA who will do the taxes for free, and they do not have an onboard or a joined LITC. So that if you have a problem, they will refer you to a different organization that is an LITC. A lot of times universities have LITCs because they're part of law schools, and they won't necessarily have tax preparation, the VITA side. The origination of both of those is IRS, but it's usually different organizations. We're just very, very lucky to here in Illinois and Chicago that LadderUp has both. So sometimes it's both, most of the time it's different.
And don't get it twisted, because they originate from the IRS, that means a lot of the funding comes from the IRS. I think, correct me if I'm wrong, they both originate from the Taxpayer Advocate, which is we don't have a public defender system in the tax system. If we did, the closest thing would be the taxpayer advocate. And a lot of that funding comes from the Office of the Taxpayer Advocate. So even though we say it comes from the IRS, I don't want you to think like it's, somehow biased. If you can think of the Taxpayer Advocate as a public defender, it's kind of coming from a public defender's office. So
Yeah.
it's not a public defender, but that's a good metaphor for it.
And the LITC funding comes from Taxpayer Advocate. The VITA funding comes from SPEC, and I don't even remember what SPEC stands for, but it's a department of the IRS. The fact that the IRS pays us really just means that we have to maintain quality control. I don't answer to the IRS about what's going on with your case. I do not. I'm adverse to them generally.
Yeah,
So,
that's actually how Michelle and I met, is that we were
Yeah.
opposite each other on a case.
yeah.
we were adversaries.
Yeah.
Yeah. Yeah.
All right. Well, thank you so much. We have had several comments that this has been a really excellent and helpful presentation, and I absolutely concur. So thank you both for having so much wonderful information and being willing to share that with us tonight. And as I said, everyone registered will get a copy of this program within the next couple of days. So thank you very much.
Fantastic. Thank you so much for hosting us. This has been really fun. And thanks everyone for your attention. Even most of you have even stayed on even through this. So thank you so much. It's always nice to have like an engaged audience.
Yeah, absolutely. And
Yes.
thank you so much, Michelle.
Oh, you're welcome.
Absolutely. Yes. Okay. Thank you, Michelle and Genevieve, and good night to everybody. And we'll see you next time around.
Thanks.
All right. Bye-bye.